The big financial story in 1979 is inflation, which has hit a ridiculous 14% this year. At this rate, the cost of just staying alive is nearly doubling every 5 years. Everyone's freaking out about how to invest their money. Should we buy gold? Should we hold bonds? Maybe go into stocks? Well, obviously bonds in an inflationary environment is not the way to go. You wouldn't put a fixed price today in 1979 on a pound of See's candy to be delivered in 2010 or 2020. You wouldn't put a fixed price today in 1979 on a yard of Berkshire cloth to be delivered in 2010. But anyone who buys a bond today is setting a price on money for use until 2010 or 2020. It's putting a fixed price on the cost of money in 30 years, which makes no sense when prices have risen 14% just this year. Okay, what about stocks? Conventional wisdom says it's best to hold stocks during times of inflation. That's not necessarily the case. Higher rates of inflation don't help businesses earn higher rates of return on equity. A business earning 20% on equity is usually very attractive. But 14% inflation changes things. 14% of your nominal return is reduced by that inflation. And most of the remaining 6% will go towards taxes on dividends and capital gains. The result is that a business with a 20% return on equity, which is usually a great result, can produce no real return for its owners. In fact, the real return can be negative. You can think of the inflation rate plus the tax rate as a misery index. This is the minimum return on equity that a business must earn to produce any real increase in purchasing power. This misery index is a bit like a treadmill. The higher it is, the higher the return on equity that a business must earn just to stay in the same place. That is, produce the same amount in purchasing power. This type of environment of high inflation makes things very difficult for investors. To put this into context, in 1964, when Warren Buffett took control of Berkshire, its book value per share was $19.46, or about half an ounce of gold. In 1979, after retaining all earnings and working hard on reinvesting all earnings, Berkshire's book value per share was $335.85, which was still about half an ounce of gold. The value of book value per share stayed roughly flat over the same period in terms of oil too. Government has printed a lot of money and created a lot of promises, but it has not been able to print more gold or oil. Although Warren is currently working very hard on investing Berkshire's money as well as he can, the stability of currency may be the most important factor in whether stock investments earn real returns. The textile business has been disappointing over the last 2 years, and true to form, this has continued, with another low return on capital. And perhaps the only good thing about it is the lesson that it has provided. Turnarounds seldom turn. It's a lot better to put your money and energy into a good business bought at a fair price than in a poor business bought at a bargain price. Take network TV stations. They earn incredibly high returns on tangible capital. They sell at really high prices too. And then on the other hand are companies like Wambach Mills, which Berkshire bought a few years ago. It earns a low return on capital. It was bought at a bargain price, but despite that, it was not a good investment. New problems kept coming up. On the other hand, a network TV station, whilst really expensive, is probably worth it in the end. Despite the poor performance of Berkshire's textile mills, the shareholders have been quite understanding because of the relationship between management and shareholders. Companies get the shareholders they seek and deserve. Berkshire has assembled a really unusual group by 1979. At the end of every year, about 98% of the company's outstanding shares are held by the same people who were shareholders at the start of the year. They usually have a long-term view of things. Shareholders of other companies can be very punishing when it comes to bad results in the short term. Berkshire shareholders are a lot more willing to stomach poor short-term results. They understand the business, they share management's expectations, and this is no coincidence. They hear directly from the CEO, not some PR person. Berkshire tries to give shareholders the information that they would want if the roles were reversed. You know, a business is a bit like a restaurant. Through its menu, service, location, etc., a restaurant develops a regular clientele over time, but it cannot cater to everyone. And it's a similar thing in business. A business will develop a regular shareholder constituency over time through its communications, its long or short-term view, its treatment of investors, etc. So, depending on its behavior, a company will either attract long or short-term focused shareholders. And that's how Berkshire has done things. They've attracted a long-term oriented shareholder group who understand the business because of the way they've communicated with shareholders.